Okay, hello there, guys. Once again, we are doing a lesson. We're doing the fourth lesson, which is the triggers and the entries. This is normally the most exciting part for the guys out there. So, trading only when we are in the profit zone. This is extremely important because this is the way we develop our edge. Our edge comes in a number of forms. When we do our top-down approach, that is an edge. When we trade only when we are in the profit zone, then that's also another edge. And also when we find our patterns, when we find our specific entries inside the profit zone, then that's another edge. So we have already 3 edges there. And then to put the cherry on top, we can say, let's go and trade only with our fundamental bias, perhaps. And that's like 4 edges. And when we are competing with traders out there, then nobody really looks at the weekly chart or monthly charts. All they do is drop down to the lower time frames and then immediately just pull the trigger, on a whim. So this few things that we have is already something very powerful and something that we can use to make some profits in the market. Okay, so we have qualified and untested resistance here on the top and qualified untested support levels at the bottom. And then this is a trend line going up toward the level. When you participate here, I'm going to ask only for Andy and Dalvin's input because I know Justin already know what's going on there, yeah, and Mark as well. So the qualified resistance level on top here, what makes it qualified? Andy and Dalvin, what will make this level, this resistance level here, qualified resistance? Remember, we are looking at the market state here. And in this market state, we have our nice little range. We only have that barrier there and a barrier there. So we are trading inside this barrier. So this is our barrier here and the bottom section here. And this is like a trend going up toward the levels. But what would make this a qualified level? Yeah, exactly. So if we have 2 touches on the line, on either the trend line or the resistance, anytime you have 2 touches, then it's a qualified level. And then what makes it even stronger is that there's an excursion beyond the mean in that area. But we don't even look at it if the area itself is not qualified. So we need these 2 dots here, these 2 points where prices has come up and it's pivoted away from there and it's come back up there. So this now becomes a qualified level if there is an excursion beyond the mean. So now that we know this area is qualified, what makes it an untested level? So we have it, prices comes up to the level, so we might be able to trade now, yeah? If prices pivots away from it and then retest the level again. So what would make this level here an untested level? Because we need qualified and untested resistance to trade short here. And if it was a trend line going up, we would need untested level there as well. Okay, I'm going to help you out with this one, yeah? Let me see if we can get a chart quickly. Okay, so what we have here is the euro versus the dollar. You see my chart in front of you? The mouse is moving on the chart as well. Okay, so this area over here is it's been respected once there and then again. Yeah, so we have our 2 points there. We have 2 touches there. Yeah, and then we look further to the left and then we see, okay, we have an excursion beyond the mean in this area. And we look to the left and we see we have our 2 touches. So this becomes now a qualified area. Now it's become tested because that when prices are there, what has actually happened here now? When prices has come back to the level here, prices has come back to the important level, it's already come down and taken profits over here. So this becomes now a tested level. So I'm not interested in looking for a trade when prices comes back there now. So this is the first time prices were tested here. But then when prices comes down, it takes profit in this area and then comes back up, back to the same area again. So now we are back trading in the same area, the same zone. It used to be a good level. It used to be a qualified level. But it was tested when it took profit there. Yeah. So it doesn't mean you can't take another trade here. It's just that this is, and it's not going to form part of what I'm talking about here. Yeah. It might be able to do that there and take profits again and do it again all the time. But what I'm really after is trying to get back to this range here. So, but then based on the assumption that prices has already come down here, I'm looking for a new level. So that is now my new level above the area. So just to repeat that, this is a level of importance there. It's been touched and respected, and it's come down and it's hit the target already, with the first initial target. Yeah. If I zoom in on this, perhaps it will make things more clear. So we have our level. It's come up back into the level, excursion beyond the mean, and then it's come down. Somehow it's already respected and touched the 5-period moving average over here, which means that I am not interested in this level again when it does this. So what I'm after now is a new level. So I'm drawing that as a new level now, new level up. And then if it's respecting this, how I'm drawing the lines here is I'm taking the body and the wick and that whole area, that whole zone. This zone here is about a 30 pip zone. I'm taking that as a new zone now, a new level. So what I need to do is just make sure that that new zone is also qualified by looking to the left and seeing if we have any sort of respect in that area. And then let me zoom back out again. And then when prices comes back and there's an excursion beyond the mean there, and then that zone would become another area to look for a trade in. Yeah. So then we would drop down to the 15-minute there because we are very close to the level. And then you'd look for a trade inside that area based on a new level. Okay, hopefully it's going to become more clear a little later. So we need the levels that we are looking at to be qualified, which means we need 2 touches on the level, whether it be a trend line or whether it be resistance or support. We need 2 of these and then draw the line, and then that becomes a qualified area. And then untested means that it's touched here, respected, and then untested means that prices hasn't gone 1/3 of the way down to your potential support here, your target at the bottom. So this is halfway through, and then this here is 1/3 of the way through. This could also mean that this is your midpoint here of your on the daily of the envelope. Yeah. This could mean that it's already reached the midpoint of the envelope, or it's gone 1/3 of the way down toward the target over here. Andy, maybe we can keep all those questions till afterwards. Yeah, maybe it becomes more clear a bit later. Yeah, so what we're talking about is the very first step of the level to qualify the level. Yeah, is to have at least these two touches, and it must be untested, which means that profits hasn't been taken, and we're only going to assume that profits are going to be taken at 1/3 of the way down. And we're going to assume that the midpoint of the envelope, which is the 5-period exponential moving average, we're going to assume that some profits will be taken in that area as well. So that is what I mean by a qualified level and an untested level of resistance. Okay, so now that we have our zones sorted out, yeah, we know where we're going to take our trades. Yeah, we're going to take our trades in these areas. We're going to take our trades when we're hitting resistance level. We're going to take our trades when we're hitting support levels. Yeah, and then also we're going to take our trades as it's going up. This is all zones that we are looking at. Profit points. Yeah, we're looking for profit points. So we are only going to trade inside these profit points. And what we are looking for is now a pattern. This forms part of the second edge now. The first edge is doing the weekly top-down analysis. The second edge is only to trade inside the profit points. And the third edge is when we are looking for a specific pattern inside of this zone, inside of this point, profit points. So we are always looking for the M's and W patterns, because that is the manipulation that the market makes. It looks as if it's an M when we're looking for shorting opportunities, and it looks like a W when we are going long. So the first entry type, the one that you've learned in the beginner strategy, the first one is the RSI divergence strategy. So we're going to assume that all of these patterns now are occurring inside the zones, the untested and the qualified zone. So we are looking for this pattern. This is on the beginner strategy. This is it's an M pattern, and this M is qualified by the RSI divergence. So we're getting a high, and then another higher high, and the RSI's got a high, but it's unable to make the same high as the price. So when you draw these points, and then it looks as if the RSI is not agreeing with the price at all. So that formed part of the beginner strategy. So we've been looking for this pattern inside the zone all the time. So it's exactly the same as any manipulation. I mean, when you look for a manipulation pattern, all you are always looking for is going to be an M pattern. It's going to be an M. Now, how this M looks is what we are going to try and qualify throughout this course. There are stops up there, and it's taking it out there. The thing is that in the market, the M's are happening all over the show, and the W's are happening all over the show. So if you're going to take all of the M's and all of the W's, then you are probably not going to make any money in the market. What we're trying to do is objectify the M, the way it looks, and also to only trade the M and the W's once we are inside the zone. So the pattern itself, it's clear, it's a manipulation pattern. It's either going to do that, or it's going to do more something like that, like a failure to follow through, or it's going to do where it does actually follow through. But this is all that we are looking at. There isn't anything else. If you're looking at a more complex version of it, it's still an M pattern. The prices are going up, it creates that there and goes up again and then comes down. It's still an M pattern, irrespective of how many waves there are inside this corrective pattern that forms the top portion of the M there. So all we're doing is looking for manipulations inside the zone. And to qualify the way the pattern looks, that is what we are doing next. So I'm not going to go over how this one works because you know the beginner strategy, yeah? The higher high and the RSI fails to follow through. So what we have here to qualify these M's and W's, we call this the fib trap. The RSI trap, the RSI M, that's not a fib trap. These two here are the fib traps. The 123.6 Fibonacci and the 161.8 Fibonacci. The reason we're choosing these ones is so that we don't use all the M's that we see. I said before that all the M's are not going to work. It works in the zone. And now, even if prices comes up into your zone and it looks like an M pattern, but it doesn't form part of the 123.6 or 161.8, then also we rule those ones out as well. We are trying to objectify what we are trading. So when we see the M or when we see the W, we need to know exactly, are we going to take this one or are we not going to take this one? Thing is, when we are trading, a lot of things goes through our minds. We want to take the trade, fundamental bias or whatever the reasons are. I want you to try and develop the reasons before you take the trade. So you're taking the trade because it's an M, but you're only taking the trade when it's a 123.6 or 161.8. So prices comes up, there is a qualified level. It goes through, it creates something that looks like an M. It makes a high, it comes down, and it goes all the way back up. Now, how high this goes up is the issue of how we're going to qualify the M pattern. This here is our midpoint of the M, and that there is 100%. So if you pull a Fibonacci down here to the 0 point, to the midpoint, and then that would be 100% level. So you have your Fibonacci pull down, and then that is a 121.3. This is the highest that the M can go. Yeah. And then you have the 161.8. Let me just explain that with a pen. So if prices are going up into the level, yeah, and then it comes back down. So what I'm saying is not to take trades that doesn't match this. When it follows through, only take the trade once it gets to this 121.8 level and it's not able to close there. The candle is unable to close there. And then it comes back down. Unable to close there, it's hovering there, it's playing around there for a while and unable to close, and it comes back down, and then you take your M pattern as you would usually do. Yeah, there. Because otherwise, if you have a price coming all the way up, it comes back down, then we can't objectify this any other way. Are you going to take that M now? Yeah. Because when are you going to say this is too far? So what I'm saying here is to objectify it so that you're only taking trades when it hits the 121.8 there, and it's unable to follow, it's unable to close the prices there. Then this becomes a qualified M pattern. And then the furthest that the last wave can do, the second wave here can do, is a 161.8. Fails to follow through here. Unable to, there can be a wick up there, and then there's a massive candle that's coming down, and then comes down, and then you can take your entry here. So this is a qualified M patterns, so that you don't take all the M's that happens even in the zone. So what's happening here is you're filtering out your trades even more. So not only are you filtering your trades when it's not in the zone, you are filtering it even when it comes in the zone now. So prices are in the zone, so now you're not just looking for any pattern. RSI doesn't matter about this one. RSI, we don't care about RSI. The one method that there, yeah, it follows through. So if there is an RSI there, then great. If not, then we look for the 121.8 or the 161.8. So all we're doing is qualifying the M pattern. And then prices comes down and it breaks through the midpoint, and then as usual you just enter the trade, putting your stop losses above the area. So the common factor in these with these three entries, yeah, Andy, what do you think the common denominator in these three entry types are? For the RSI divergence trap, the fib trap, and the 123.6 and the 161.8. I might have said the wrong fib as I was talking, but these are the right numbers. Yeah, 123.6 and 161.8. All of them are going to be M and W patterns. Yeah, the whole lot. If you look back to any of the trainings or anything, we never take trades if we can't see a M pattern. Have you noticed that? Just look at this one. Let me draw this. We don't take trades if we don't see an M pattern. If it does this and it's doing this, a lot of things there before it comes back down, this in itself is still the M. There is our first leg of the M coming up, that piece, and then we get our midpoint, which is there, and then it goes back up again. So however complicated the M looks, with Mark Chapman, we're calling this like an iceberg, but it's still an M. It's a very complicated looking M, but it's still an M pattern. No matter what we're doing here, and at the bottom here we are looking for the W. So no matter how many complicated levels there are, complicated waves there are before it starts moving the right direction, it's still that W pattern when we are buying. So the common factor in these three are that they are all following through. So if you have the M pattern, the first leg, the second leg, this third leg is always following through. With a divergence trap, we are looking for the RSI to qualify the distance of that M. And then we're saying that is fine because the RSI is okay with that one. So that M is qualified. The next M is again a follow-through version where the last leg follows through. What I mean by follow through, it is looking as if it's a push up, a pull back, a push up, and then another pull back, and then maybe a push up that's following through. Now, the second M here is qualified by 123.6. And then we have another M. You see, they are all following through here. 161.8. The furthest that it's allowed to follow through is 161.8. This is so that we can objectify the way the M looks. The thing is, if we take, if you're doing it this way, you take an RSI, you can say that I traded 15 times with the RSI pattern and it worked 7 times out, 7 times. When I traded the 123.6 out of 15, it made 11 hits. And what I mean by hits, it's come down to at least 1.3 of the distance, of the total distance down here. And then the 161.8 might have, out of 15, had 5 wins. Then, but what we have here is so much power, it's unbelievable, because you now know the M qualified by the 161.8, I'm ditching it with the pound versus the yen because it doesn't work that well. But when I traded this on the euro versus the yen, it worked perfectly. But they are all qualified. But if you now jot down and you record all of this type of thing with this My FX book, all you need is a photograph of the entry. And you will know I got in. It's going to be a no-brainer. You got into the trade because you were in the zone. Yeah, it's going to be a no-brainer that these are now also zones, remember, as it's going up, not only the support and the resistance. Yeah. It's also a no-brainer that you are looking for a manipulation, and the manipulation comes in the form of an M, however complicated. Then we're looking for the qualified M. Otherwise, we're never going to be able to measure what we are doing here. We're never going to be able to quantify what we are doing here. Because everything is M's, complicated M's or whatever. It's all an M or a W pattern when you're trading manipulations. There's nothing else. There is nothing else. This way, you are objectifying that pattern. How many times does my 161.8 work between bloody 4 o'clock to 5 o'clock? You can narrow this down, and all you need is the link to some sort of a My FX book thing. I don't know what Andy uses as a substitute. Andy, you must let me know, yeah, because I know you trade with TradingView. So all of this is just to objectify what we are doing, so that we can add quality and quantity to that M, so that we can then decide to use it or not. Because what happens is when people trades manipulation or any strategies, they'll just say it doesn't work, but they wouldn't even know what it is that's not working. Caught in that trap forever, jumping to the next strategy. There is no next strategy. This, the trading manipulations like this is the strategy. Whatever you've traded in the past All you do is look for these patterns and qualify them, and then use the ones that are working the best for you. But you wouldn't know what works best for you if you don't qualify it. So the common denominator for the RSI for these three entries is that it all follows through. So the next one is the failure to follow through, the M and the W. So how are we going to qualify when it fails to follow through? That's what we need to do here. So it's going to be exactly the same. There we go. It's an M, but in this case, it doesn't follow through. This red dots here denotes a follow through. So it's not following through, but where does it stop then? So we don't want to take all the M's on the planet that looks like it's failing to follow through, because there's going to be a hell of a lot of trades. Yeah, you'll be trading all the time, and then I'm afraid that's what we like doing. We just like to be trading all the time. Try it this way. Try qualifying the entry, the failure to follow through. Here we go. It goes up, comes down. There, it's a follow through now. Yeah, because it looks as if the trend is going up and following through. The version we're talking about here is an M that fails to follow through. You go up, it comes down, and then it fails to follow through. It stops there, but where does it stop? We want to only take trades when it stops at a certain area. And that's the 786. 78.6 Fibonacci level. That's where it stops. What I do is if prices comes up there and it touches there and it fails to close there, and it's still respecting that, then I am happy to take that trade there. So it's again, we have our candle with our wick situation, and that's our 78.6. So it breaks through the 78.6 perhaps, but it's unable to close there. Now I'm very strict on that. For me, I don't like it when it closes up there. Yeah, and comes down. You can test whether it works for you, that it closes up at 78.6. That's your 78.6. It closes above the 78.6. You can take that trade. Yeah, just jot down in your diary or journal that you're not too bothered about where it closes there. Yeah, but for me, the candle wick can breach the 78.6 and then close down below the 78.6. So it's a wick, and then the candle comes back down. That's my 78.6 there. That's how I like doing it. So there's my 78.6. It fails to follow through. You have your midpoint of your M, and then that's your 100%. 100% is the highest that it's ever been. So you pull down the Fibonacci point to the midpoint, and then the 78.6 is where you would look to qualify that M. So far with those M's, the failure to follow through and the follow through versions of it, do you understand that? Okay, perfect. So now the types of traders that we have, we always need to bear in mind that this is a psychological game. So what do traders do at specific levels? Yeah. This one is going to be called the circle of liquidity. I like this one very much. My favorite of all of them is probably going to be the 78.6 and Actually, all of them are my favorite. I'm not gonna say it's my favorite. I just like all of them. With this, there are more steps to qualifying the M. There are more steps, um, but it just makes the whole thing more exciting. Like you will see now, prices are this is your level, your zone, guaranteed good level, because we have our respect here and everything. Yeah, we have all the qualifications that's necessary. Prices are trading up here now. Prices comes down, and I call this the circle of liquidity now. Now it hasn't breached my 1/3 yet. Yeah, hasn't breached that yet. Remember, we need an untested level, untested zone. And then we have our favorite stuff, which is the entry cheese. Now, I like mozzarella because that's good for my diet. I don't know what you guys like. Yeah, I know South Africa has they like cheddar. Here in Switzerland, they don't even bother with cheddar. Okay, so we have our cheese here. And what is cheese? Cheese is the level traders coming into the market. So you have now who are the level traders? They are the most aggressive ones. Yeah, I used to be a level trader all the time, and before doing it this way. So you have your entry cheese, which is the level trader. They wait for at the level, expecting it to go, to the next barrier. Yeah, they've tried it year before, and year and year. It comes back down, and then they've tried it here. Aggressive traders. So they obviously put their stops here. They're not going to put their stops anywhere else. And I think that's going to just continue going on, forever with trading. We just put our stops 5 to 10 pips below this always. I don't know why that is, but that's the case. Then the next group of traders here is what we call the breakout traders. So the level traders is this yellow bit here, and then the breakout traders. So they had the other idea. They are also aggressive, but their idea is that the prices are going short. Yeah, the other way. But what they are doing as they are coming into the market is they are taking out the stops that the level traders has put in. And then as they are doing this, they put their stops up there. So you can see here now the circle of liquidity is forming. All the types of traders needs to have their stops all taken out before the manipulation traders comes in, like us. We're waiting for the whole thing to happen before we pull the trigger on the circle of liquidity. So we have our level traders here. Then we have our breakout traders. Now they are both aggressive. And then the less aggressive of the guys are coming in, and they are the retracement traders. So what are they doing now? They also want to be they feel they've missed out on this breakout. Yeah. So what they're doing as prices are coming down here, as prices are coming down here, yeah, the breakout traders, they break through, very happy. They're putting all the entries and stuff here. So it breaks through and they put their stops up there. So they are very happy when prices are down here now. Yeah. They are very happy here. But then the retracement traders, they feel they've missed out on this opportunity. So what they are doing is now waiting for prices to become cheap again. They're waiting for prices to retrace. So whether it be 50% retracement or 61.8, whatever the retracement is, it's based on this line here. So this is about 50%. But they don't care what they want. The more aggressive they are, the smaller the retracement they need. Yeah. Some of them wait just for their retracement and then hoping that it just follows through. Others are waiting for a deeper pullback and waiting for the follow through. to happen. But what we're saying here is that the level traders are in the market already based on that entry cheese there. The breakout traders are in the market there, and then also the retracement traders. So we have all three types of traders inside the market already before we start pulling the trigger. Now that's based on the circle of liquidity entry. Yeah. So all the stops of all three of those types of traders must be taken out before we become interested. So our entry here is going to be in this area here, that area. So the circle of liquidity means that all of the types of traders are inside here. Not one of them are missed. There must be the entry cheese, there must be the breakout traders, there must be the retracement traders, and all of their stops must be taken out. Then that is the circle of liquidity entry type. We don't care about the RSI divergence here. We don't care about anything else. All we care about in this entry type is the circle of liquidity. And then for the last of the entry types is going to be the conservative entry. Justin says stinky cheese. Right, the conservative entry. Now, I think there was an example of a conservative entry in last week. It was, I don't remember the pair. Look, you know when prices are trending on that bloody 5-period moving average and you don't know when it's going to go down. You don't know how far it's going to go down. You know that this is what our style of manipulation traders hates the most is this. You know, we hate this because we want to go long. You know, we're looking to go long. And but the thing is, it's just trending down. It's just trending down. It's like, when are we ever going to go long? Now, still, what we do is just try and qualify the level. Normally, in a case like this, we only find the zone qualified much later. What I mean is the points here when we're looking for this to be a zone. Yeah, we're looking for that to be a zone. Then only 1998, we find our respect there again, you know. And then that's, it's not good enough, really. So I don't know, but we know that this is what we see a lot nowadays. Yeah, it's come down look at the New Zealand dollar versus the yen sort of thing. It's horrible. Yeah, it's keeping on going, and this is the 5-period moving average on that daily envelope. Once you see prices are hitting a 5-period moving average, it's a trend, man. You know, it's a trend, and we are looking for when we are rather inside a zone like this. Yeah, we want to trade in that sort of a zone. But we are faced with this. So the best way of doing it is going to be the conservative entry for that style or that look. When it looks like it's trending, the conservative entry is going to be the best. Now, let me explain what that is. So the sellers are in control on this trend coming down. And the biggest of the sellers here, is going to be the one that most recently put in the lowest low, which is this guy here. So prices are coming down, up, down, back up again, and then down. They are the ones that needs to be taken out before anything else. So if we look at anything that happens here doesn't matter. The sellers are in control. The sellers are in control here. Yeah. So we don't look for our buying opportunities now because the sellers are still in control. So irrespective of if this happens here now, you got a nice little pattern going on there. All of that, it's perfect and everything. For me, this is trending down. Yeah. And these guys are still in control of the whole game here. So in a trending situation like what we're having now recently, a lot of the time on the 5-period moving average on the daily, or now that you guys know about Heiken-Nashi, when you see this thing trading on the 36 EMA or even on the 12 EMA, then you know it's trending down. So the best way to do it is to watch these sellers who are still in control of the market here, irrespective of what happens here. And the only time that we can really conservatively, hence the name of this entry, the only way we can conservatively trade long is when we have a break of the sellers here and a close there. So now we are fairly confident that these sellers are taken out. And then you need a pullback. So that high up there, yeah, needs to break before we can call this a conservative entry. So the first step here is the conservative, with the conservative entry, is the control is still the sellers until this point has been broken. Because we're still considering this a trend, a downtrend, until they are taken out. Eventually they are taken out. You need a break and a close there. And then a pullback wherever it comes. It doesn't matter where it comes to. It doesn't matter. Yeah. And then what we're going to need is a break of that high there. And then that is your entry point. So aggressive traders are going to put their stop losses here. Let me just write this in. So if you are aggressive, then you're going to put your stop losses there. And then if you are conservative, you're going to put your stop losses down there. Now, all my entries that I do is always going to be on the 15-minute. It becomes more conservative and probably higher probability of the thing working if you're going to do it on the 4-hourly chart. But if you do the conservative entry, it's where I have my stops the widest. And that's on the 15-minute, yeah. So I can't imagine how high your stops are going to need to be on the 4-hourly doing the conservative style. But if you are a conservative trader, then I mean, by all means, of the 4-hourly is also good. Yeah, it's going to work probably more times than it does on the 15-minute. But the logic behind it is that it's conservative because you're really waiting to be 100% certain that these guys are taken out first. Yeah. Let's see what else. Okay, that's for next week. Let's just go quickly to a chart. But Andy, what are those questions that you have? Let me just go to a chart quickly. You had some questions. Was it answered in the meantime? One third or mid daily envelope, what has the most weight? You see, now those are great questions because you now know that You during the testing phase, you're going to see how many times this thing gets to the midpoint and how many times it gets to the envelope. So for me, if it gets to the midpoint, I'm counting the trade as a winner, and I am looking to take profits depending on how prices has approached that midpoint. So the weight there, it doesn't matter, because if it's breached any of the two, then the level for me is no longer a good level. Let me go back to a drawing thing here instead. Okay, so let me just draw this again quickly. The thing is that if there is a level, it's only a level for me if it has at least 2 points touched and respected. And from that level, if prices comes back into that level now and it's pivoted down and it hits the 1/3, then I don't bother anymore. For me, then that level is no longer a level. I look further up for another level. Or if it has come down and it's hit the midpoint on the daily. So either of these things, I am going to assume that profits has been taken and that the level is no longer valid for me. Now, the only reason we're doing this is so that we can at least know when to give up on a level. And through the experience that I have, I give up on the level when that happens, when either of that happens. I look for another level. Because I'm looking at 28 different pairs, I don't need to bother about one level. There is another level up there, and there's another level up there. So all I do is look for 2 points, and has it been tested, come down, has price hit and come down to 1/3, or has it come down to the midpoint? Any of this that happens. So for me, if I should be forced, then I'm going to say that to me, I'm treating them equally. The 1/3 and the midpoint they have equal weight for me. If it happens, then I look at a new level. Yeah, it could. But then obviously if it does that, if that is now my entry cheese and it comes back up, then what is entry cheese? Entry cheese then needs to be taken out, and maybe does it here at the second level. And then I can start again. You can trade when it gets to, this is how I qualify. If there's no level, then I don't trade. You can qualify these levels the way you like. If you say that you're looking for 3 points before you interested in a zone, then that's what you do. You look for 3 points. For me, the minimum is to qualify it with 2 points. To me, if you say that you don't like it if this thing goes down 20 pips, irrespective of the relation between a third and the midpoint, you don't care. You say 20 pips is too much for me. 20 pips is too far down. I don't want to take this as a level anymore. What I'm suggesting to you is have that in your plan, that I don't take the trade when it's 20 pips, when it looks as if profits has been taken. I don't take the trade if the if the zone hasn't been qualified by more than 2 points, but consistently act in the same manner all the time. Now, I'm putting these rules down because these are the rules that I use, and I can now qualify a level and I can go ahead. Otherwise, we're going to dwell on levels because there are so many. There are just too many and too many charts to look at. You will soon feel this thing when a level, you will look at it and say, no, this doesn't look the same how it did the last time, so I'm not going to trade it. Or it doesn't have two level spots, and I'm not going to trade it. But you need to be able to qualify these things. These rules are my rules of qualifying a level. You need to qualify your level. Otherwise, you'll be trading all the levels. And then when you go back to looking at what you did wrong, you wouldn't know because you just took anything that looked like a level. This is why we need to qualify the level. And the levels are the most important thing. So prices, if this is our a level at the bottom here, and prices heads down into it, and you're inside it, you've qualified the level, then I'm looking on the lower time frame to trade. You can look on the existing chart on your H4 to see if it does the pattern that you are looking for. But I like looking at the lower time frames. I like the 15-minute. The philosophy or the reason behind 15 minutes for me is because the banks and hedge funds, they look at the bigger time frames. They look at the daily, they look at the weekly, and the 4-hourly and the monthly. So that they're looking on these areas, they're looking for where they're going to trade and where their potential targets are. Now that's what we're doing. Now, who trades on the 15-minute and on the 5-minute and on the 1-minute chart? Who trades here? Yes, retail traders trades there. So what happens there is manipulations because the retail traders get stopped out. That's the reason I like trading on taking the entries on the lower time frames. So I'm equal to the bank and the hedge fund when I have a bird's eye view of what's going on in the market. I'm looking at the whole picture. I know where I'm going. I can see my zones and stuff on the weekly. So, and on the daily, I can see if I'm trending. So I'm looking for entries there and I'm looking for entries there. So I know what I'm doing. Then as prices are coming back to the level, now that's qualified because we have 1, 2, depending on how far the distance is here. I'll be looking there as soon as prices hits because I am the same as the hedge fund and the big bank. I know I want to trade short and I know I want to do it in that area, but also I want to add some edge. I want to look on the 15-minute where retail traders are trading and I'm looking for a manipulation there. I looked for that same manipulation there and there. So just to add edge, I don't want the profits to be taken already. If it does, and then I'll look for another level, looking up there. Definitely. So it is acceptable that you're not always going to get 1:1. Yes. If price action, that is what dictates to us really what we are going to do here. Our we hope, yeah, and we wish that we always get to the next level. When I'm trading and it hits there, I'm always looking to aim for that. And if there isn't enough profit in this area here, then I don't want to trade, which means prices comes up here now, and then it comes down, and now it's 1/3. Now, depending on what it's doing here, I say, no way, I'm not going to bother with this because this looks like a bloody perfect entry to go long. And it's happening inside the 1/3, or it's happening at the 5 exponential moving average based on the daily, the midpoint. This is happening at the midpoint, one of your setups is happening to go the opposite direction on the 5-period moving average or on the midpoint. So then I'm looking, so, I think I'm going to move my stop down. I don't want to get knocked out here now. In the risk, you will see that I take 3 trades here at this point. What happens is that I will close 1/3 of the trade here, and then I will keep one completely open for risk, which means that's only 1/3 that's open for risk. The other one is at break even. So I'm not losing anything here when this happens. I don't care about 1:1. I care about what the price is doing at that level that this 5-period moving average, if prices are coming down like this and it gets there again, the highest probability is that it's just going to do the same thing that it's done all the time. It follows this 5-period. We are asking it to do on, just because you are in a trade now, just because you are trading here, you are asking, please don't do this anymore. Please break that 5-period moving average just for me once. But it's been doing it all the time following the 5-period. So watch those ones, the yen and that, the New Zealand dollar yen. It's been trending on that 5-period moving average all the time. So what do we call that? We call that a trend. And if we are not in that trend, trading in the direction of the trend, don't ask it to now follow your strategy suddenly. It's been trending on the 5-period moving average. Past behavior. If it's trending on the 5-period, that's what it's doing. Trade it in that fashion. Right, now let me go to a chart quickly. Right, so what we have here is our Heikinashi. Right, so so the idea was to look for the entry points. So if you see it's trending, then you look for one of our entries there. Yeah. If you see it's trending, then you look for your entries on the trend line. So obviously here now, if prices gets to this level, we can look for an entry short, depending if we are okay, if we did our top-down analysis. But if not, what we are looking for is a come down here, retracement coming down and then retesting that trend line and then looking for the entries there. These are all zones. So if we go to the 14th of October here now, then we need to look for one of our entries. So prices comes down into the zone sort of a thing, and then you're looking for an entry. That's the first one. You see, we've highlighted the zone. So inside, when prices now gets to the zone, yeah, prices are inside the zone. So now you need to be on high alert for whatever you are looking for. Yeah. So we are inside the zone. So then you take the Fibonacci, and then prices has come down all the way down and then back up. So to qualify that, we do this. So that is a 123.6 entry qualifier, like a W. But this W is qualified because we are inside the zone that's been previously identified, and it's a W, and it had a follow through of 123.6. So that trade is okay to take. Yeah. And then we've highlighted another zone somewhere. Yeah, we came into the next zone. Prices comes down into the zone again. Where is it? The beginning, yeah. So prices comes down into the zone. So now we again on high alerts for another sort of a pattern. So here we find another W pattern. So you get your low there. You pull it up to the highest point with your RSI. And then again, beautifully tested on the 123.6 exactly. So not just any W pattern inside the zone, but what we are looking for is qualified areas, qualified patterns inside that zone. I told you the M's and W's happens all over the show. Yeah. And that one was a nice one. It went very nicely up there. And then if we go back to the daily, so what we've done here is we highlighted these two areas, and then that is where we traded. And then here is we are looking for a retracement. And then in that zone, again, we would be looking for the area. We'd be looking in that area for another pattern that qualifies. 123.6, 161.8. Or you're looking for the RSI qualifier, or the failure to, or not the, or the conservative entry, or you are looking for the circle of liquidity, or the standard RSI divergence entry. So all of these zones is what we are looking for. Like if we found a trend line like here, then in this area, say for instance, this was a trend line, then that's where we would look for a trade. And then this here is where we would look for another trade. Yeah, and as it goes, then this year we would look for another trade. You see, it has actually happened here on this one. And there was a trend line coming down, and there was some action in that area. There. So what we do when prices gets there on the 12th of December, we're looking to go short. Prices comes down into the level. Here we have prices inside the area now. So we would look inside this area, inside that zone. We would constantly look for trading opportunities inside this area. See if I can get rid of that. Charts, objects. Yeah, so what we have here is prices. This is the zone we've identified. So prices makes a high, comes down to the midpoint, and then we'll see. So this one didn't qualify, didn't reach up to the 78.6. So I wouldn't take this M pattern up here. But you see, it's all M patterns. That's in this case, it wasn't qualified. Let me just draw this here. Here you see prices going up, making a high. It comes down. So that's my like a midpoint. And then in this case, it fails to follow through, but it fails to follow through at 61.8. So I'm not going to take that trade there. But now doing it this way, waiting for that, you can qualify it. If you want to use 61.8, you can do so. I've been testing the 78.6 all the years, and this is the reason I like trading 78.6. So I trade failure to follow through patterns only when it gets up to there. If it had touched here, then I would be in on the trade there. Qualified M. This is an unqualified M for me. You can qualify this at the beginning of when you start using a journal or when you start using a trading plan. You can say, look, I qualify both of these 61.8 and 78.6 when it hits a zone. Failure to follow through at 61.8. I use 78.6 as a failure to follow through. So all we're doing is finding areas on the chart where we would want to trade and then qualify what happens inside that zone, inside that area. Do you have any further questions on that one? All the entries are used on the trends as well, yes. Exactly the same entries. The only thing is, if prices are trending in a trending fashion, then it is always going to be best to use that conservative entry. So prices are going up. So now we've got a qualified trend, right? Because we've got two spots there. So this guy here is the one that needs to be taken out. So he needs to come down there, close there, pull back, and then boom. Stop up there for conservative and stop there for higher risk guys. Yeah, that's if it's trending. I find using the conservative entry better when we are trending. What else is on here? Yeah, so that is all, guys. So do you have any further questions there? Like, what's this one? I wasn't looking at this. I was looking at this. Yeah, this one here on the daily. Yeah, I was looking at. So we have the level here. So this level has now been tested already because prices has come down. So if you look at it, the amount here, there is your wick, and then there. That's 70 pips. Yeah. So I would take the profit there, even though I'm looking to trade to get 300 pips. Yeah. That's what I mean by untested level. But then look here how close my next level is here. So now for me, I'm quite strict, whereas this is still hasn't touched that level. You see, so when I drop down to the 50 now, I am taking into consideration that we didn't really touch that level. So that's one point that is that's against me there. The other thing is, now you see prices are coming up there, and then it makes a highest high. I pull the Fibonacci down, and there it didn't get to the 78.6, so I'm not too interested coming down there. So I'm looking for, if this was inside the level, I would be looking at trading the 78.6 sort of an M pattern here. But you see how big the M is here. So obviously on the 15 minute, I mean, if you like trading 30 minute and all that other stuff, it works on all of the time frames. But I trade off the 15 minute mostly. And then on the Heiken-Nashi, so these are all the areas I would trade. When prices are trading on the 200 EMA, I would be looking for entries there. Yeah. So 9th of December. So what we have is a trend line maybe breaking here, looking for a break up and a pullback. And it pulls back here to the 12 period moving average. You could also be looking for one of our entries there. Depending now, but what I'm suggesting is, again, for you to know what you are going to do based on your trading plan. Do you trade on the 12 period moving average? Do you trade off the 36 period moving average, or must it hit the trend line? Yeah. So all of these things needs to be identified in your trading plan. Don't trade all of these all the time. But if you do it this way, you'll be able to justify what it is that works and what doesn't work, because there are all M's and W patterns here when it gets here. It doesn't happen in another form. It could be that V, but then nobody knows how to trade that when it just comes down and goes back up again. The only way we can trade is when there's a W and M pattern. Inside these areas here. Yeah, let's look at this one on the 9th of December. Let's see if there was anything in that cluster there. 9th of December. So here we have this. That was the zone that we've identified there. So what we have here is, you see, we don't have one of our qualifiers here, but what we do have is a trend coming down. These are the guys that put in the high. These are the guys that puts in the high. It breaks through the high, it closes, and then it pulls back. You put your stop loss below here. So that's one entry inside the zone. And in this case, on the 15 minutes, it's also respecting, and all this fun is all happening on the 200 moving average and the 633. This is just qualifying your zone that you've identified even better. Yeah. The zones that you've identified here are even more qualified now on the 15 minute. Right. For the homework, what you need to do is all of the 6 entry types. Find all 6 entry types for me on any charts, preferably the 15-minute time frame, and in a zone. So identify the zone either on the daily or on the 4-hourly. The zone could mean that prices has hit the 12 period or the 36 period or a trend line. Just find a qualified zone and then look inside that zone for all 6 of our entry types. And that is the homework for you. Once you're done, then you let me know. Then we'll go over the homework, and then we can discuss further if there's any questions that you have. And for now, do you have any questions? No, Justin, you can't ask. Yeah, ask. Go ahead, man. Right. So, how is the trend line qualified and untested? The trend lines are going to be qualified when we have an actual trend line, which means that there must be 2 touches on that trend, because you can't draw the 2 points without there being 2 touches. Let me see if I can just draw. Yeah, Dalvin, it's being recorded. Let me just see if I can draw the trend line thing or find trend line. Let's say, Justin, if we are looking at this as a trend here coming down. So we have the point comes down, right? And then up. So that's point number one there. Then down and then up. So now you can actually draw a trend line because you've got 2 points, 1 and 2. So that becomes a qualified trend now. You have 1 point coming down to 2 points. So now that becomes a trend now. So you can look, if you were going short, you can look in that area. And the untested thing here is going to be the same. If it's gone too far, and for me too far is 1/3 of the way to my next target, which probably going to be that. Yeah. That is how I'm having an untested line there. Yeah. And then for me, that would be a break of a trend. And then what I'm looking for on the lower time frame is a break, pull back to the 12 or to the 36, and then looking to go long there and looking to go long like that. So I'm sure if we look at the uptrend there, we can see if we can identify something. Let me just see. Yeah. Let's see if I can identify a trend going up. This is obviously a trend and it's volatile. There's a whole lot of yellow candles on the 4 hourly there. So it's been going up, up, up all the time there. So, and then we have like a trend line break situation. Or you can see that it's volatile when it's following the 12 period moving average there. And here the trend has now been, changed its angle due to the volatility. But you look for your trades, if you are a 12 period moving average sort of a guy, you look for your trades on the 12 period moving average. So here you can see again, something's happening, either deciding to go long. This is what I meant with the trend line. When it's trending and you want to go short, then see who's in control here of the long trend. It's this guy here. So the conservative entry would be below here. You'd be looking for that to happen. Yeah. Instead of being aggressive and looking at what I've showed you before here. And also we need to remember that we didn't really hit the zone. It all depends on what you feel here. Yeah. I would like there to be a stop point above that area. But a lot of the times when I said that, then prices just, smash down. Remember, my bias is going to be against the euro anyway. Yeah, it's only going to be qualified, the trend line, once you get once it's on the second point. But remember, we have our strategy. It's high risk. High risk when we trade it on any other of the points of the trend. So the trend is only a trend when you have the 2 points. It's never a trend when it's not that, you see? So if you have something coming down here like this, and you have a qualified trend line and it breaks, then you're waiting for the trend line to break there, and then you're looking for entries there. But all depends on, what happened in the past. Did you use that zone And is that a zone for you? You know, if you are too close to that area there, then also there is no room to go. You know, if you are like 20 pips away and you are here, then you don't really want to trade that trade. Even you, no matter how nice it looks. Okay, so guys, the homework, once you're ready with that, let me know, and then we can discuss further if you have any questions on that. Okay, thanks very much for joining, and we will speak soon. Bye-bye. You did a